Do you want to become a savvy investor? Like growing anything in the garden, you have to have the right tools and know the proper steps in order to grow your wealth or your money tree. Perhaps you've created a small nest egg. Perhaps you've inherited some money or sold a business. Perhaps you've worked hard to build up your 401k. But investing just isn't your expertise. A lot of people have expertise in other topics, but when it comes to investments, it's just not their thing. You need to start with the basics. And one of the key basics to growing your wealth while preserving your sanity starts with a great line from Shakespeare, "To thine own self be true." But how can you be true to yourself if you don't know who you are investment-wise? This part of setting up, in garden terms, the soil for your money tree, because everyone wants a flourishing money tree, right? I'll walk you through it. I'm Marianne Montaigne, which rhymes with champagne, and I have over 30 years experience as an investment analyst and portfolio manager. I've been doing this for over 30 years. And during that time, I've spoken with hundreds, perhaps thousands of individual investors, many of whom have told me their horror stories about their first attempts at investing and mistakes they've made along the way. There's a lot of ways to lose money in investments, but they didn't know how to invest. And that's why they made these bad decisions, particularly early on, which is the most important time. You know, we want to have our money growing and compounding, and the longer you can compound, the far better off you will be. Here's my personal story. At 40 years old, I found myself divorced with 3 kids and no job. I had been out of the markets for about 10 years, and I had to, be concerned about how I would get back into the business. I was very fortunate. One of my former bosses hired me back. And I had to worry about college that was upcoming for the kids. I had a very small IRA through my ex-husband. He kept the larger one because he had the better lawyers. And I just lost a ton of sleep trying to make it financially, keep the kids in the same house with me, the kids in the same school, the same neighborhood with their friends, and that college was just always looming. But my ex controlled the investments for college, and I'll have that as a topic for another podcast. Today, I have 3 grown children and 7 grandchildren with help from my stepdaughter, and a very sizable investment portfolio that can generate income to help fund my goals. And a beautiful potting shed, shed, thanks to my smart, creative, and handy husband, Bob. My mission is to help you become a savvy investor from this point forward, and in the process, save you from lying awake at night, worrying about how you would ever fulfill your obligations, your hopes, and desires for yourself and your family. You know, money buys you freedom. That freedom can make you happy because it gives you independence, a sense of wholeness, and a safety net. My goal is to help you sleep well at night by achieving some self-sufficiency, some contentment, and that safety net. While there are no guarantees to investing, there are certainly some ways to guarantee losses. And in this series of podcasts, I'd like to help you grow your wealth and avoid those costly mistakes. How? By getting you on a plan and keeping you on course to grow your assets over time, kind of like nourishing a money tree. But before you can invest in anything, you have to ask yourself 4 critical questions. Have you laid the proper groundwork? And these are the 4 questions for that proper groundwork. First of all, are your bills paid off monthly? If not, you need to get that under control right away, starting with the bills that carry the highest interest rates. I know a guy who put his credit card into a big block of ice in the freezer. He literally put his card on ice so that it wouldn't be easy to reach for whenever something sparkly came along. And it helped stop the bills from accumulating and helped him to pay down his debt. Also, buy in quantity. Speaking of freezers, when you see things that are on sale that you know you're going to have to use anyway, buy them and stick them in the freezer. Did you know a freezer is more efficient when it's full? That's a good way of saving money. And you can also just look in your pantry, open your closets and find out what you already have. And that will stop you from going to the stores on a daily basis or even over a course of a week. Just utilize what you already have. Next, did you know that you could save over $1,200 a year by simply using K-cups for your coffee instead of walking into that store and buying the coffee? You'll probably add on something else too while you're getting the coffee, so the savings is probably more than $1,200. But I've taken into account the cost of buying the machine, the coffee machine, for $100. Another way is to pack a lunch. Take some leftovers. Just utilize what you have without going into another store and adding on what they have. Now, why would I give you these examples? Because while I'm out to make good money in investments, I'll also stop to pick up quarters. Next, do you have 3 to 6 months of expenses set aside in savings? Why? Because stuff happens. Usually when you least expect it. Just look at Silicon Valley. I mean, look at all those tech workers. They've been hiring nonstop for years, right? Well, not in 2023. They've been laying off a lot of really good qualified people, and they've had to scrounge to make ends meet until the next job is landed. It happens to so many people in so many industries. It's happened to me and a lot of my associates in the financial services industry over the decades. Next, do you have insurance to cover you in case of an accident or worse? Now, things happen, but bills don't stop, and your loved ones need protection. Protect them. Protect them from struggling financially as well as emotionally if something really severe happens. My 40-year-old brother-in-law died suddenly of an undiagnosed illness and left a wife and 2 small children. Very fortunately, they did have good insurance, and she was able to stay in her house. The kids stayed in their schools. They were able to not only fund college, but also further degrees for each of them. But without that insurance, it could have been a completely different story. And it can be very life-changing if you don't have insurance for them. Finally, are you ready to invest knowing that the money you've put into the markets may not be there 100% when you go to reach for it? You want to have liquid investments so that you can reach for them, but the value may have gone down. That's just volatility, normal volatility in the stock market. So what you want to do is note that whatever goes down doesn't come straight back up, as one of my friends has learned the hard way. Some stocks may just have more volatility than others, and some may just be higher risk and may just, go the wrong direction. So can you answer yes to all 4 of those questions? Are your bills paid off? Do you have money set aside for 3 to 6 months of expenses? Do you have insurance? And you realize you may not be able to reach for 100% of that money when you want to. These can be life-saving decisions, and when you have answered yes to all 4 of these questions, then you are ready for the next step. You can't help you unless you understand your likes and your dislikes. I heard Angel Gregorio, the owner of a spice store in Washington, D.C., talk about the fact that people come in all the time and ask, what should I buy to flavor my chicken? And her response is, I don't know. I don't know you. I don't know your palate. I don't know your flavors. How would I know what you're going to like on your chicken? What do you like? It's similar with investments. You have to know you. What sits well on your palate? What's too bland? What's too spicy? And you can't have a successful strategy in investments over the longer period if you can't stay with them, if you can't stay with them for the longer term. So let's discover who you are from a risk standpoint. Imagine you just accepted an invitation to a pool party in a couple of weeks. Quick, what are you going to wear? Well, I'm going to give you a choice of 3 styles. Maybe you fit one of these. The first would be A. You're going to wear some floor-length dress or pants that may be made with SPF 50 material. You're going to wear a hat, also made of SPF material, sunscreen, of course, SPF 50, and some kind of shoes and sunglasses with sun protection. And you may even add a sun umbrella, just to be safe. Second choice, you're going to wear attractive shorts and a top, some sandals, some sunscreen, and yeah, that's about it. The third choice, or number C, is the skimpiest thing possible. Maybe a bikini, think something like dental floss. Maybe you'd even spritz in some sun-in to lighten your hair. And your thought process is, well, let's give this a go and see what happens. There's certainly points in between those 3 choices, but do you feel what I'm trying to impart upon you? Choice A describes the most risk-averse investor, someone who wants to be protected and not soak up any raise or moderate gains, lest you become a victim of the environment. This is the shorts, tops, and sandals choice. So choice B reflects the moderate investor. This is someone who says to themselves, well, people probably won't be in the pool anyway, and it might rain or be cloudy, so you just don't know what's going to happen. They don't expect the highest returns as investors, but they're comfortable in just staying in the game and making some money over time. And C, the skimpiest thing, is for the risk taker, the person who will take on the highest level of risk in the expectation of getting the highest returns. So now you've identified who you are in the range of choices. You know about your risk profile, your comfort zone, and somewhere in between ultra conservative and ultra risky on the other end of the spectrum. Next, let's talk about timelines. Are you looking for a quick trade? Are you investing for the long haul, for retirement? How far away from retirement are you? We'll go deeper in this topic on a later podcast. Now, the longer you stay in the market, the more successful you will be generally. Did you know that the stock market rises 3 out of 4 years? Not necessarily consecutive like that, but 73% of the time in over the last nearly 100 years, the stock market has gone up. And that's also true for the last 20 years. 3 out of 4 years, or about 73% of the years, have been positive for the S&P 500. Now, if you had those odds in your favor when you're at some gaming table, would you pick up and leave and go buy some bling with that? No, I think you'd stay as long as you possibly could if your odds were to be positive 3 out of 4 times. Years ago, when my father was 65 and retiring from a major corporation, he asked me about how to invest. And I recommended for him, not for everyone, but I recommended for him that he go into the growth stocks. The reason being that his father was close to 90 and in great health. His grandmother had lived to be well into her 90s in great health right up to the end. And it was, appropriate for him to take that risk, thinking he probably had another 30-year time horizon, as a lot of people do nowadays. But fast forward to today, and my dad's portfolio is primarily large cap, blue chip stocks, good dividend payers, good dividend growers, and a few bonds. He's still doing well and looking for the next hot stock tip from me at the age of 103. Now let's shift gears and talk about individual investments. When you exit one investment, and you're probably going to invest in another, it's like changing horses in a long distance race. Was the other horse getting slow? Will the next horse be much faster? This is a critical decision. Perhaps it would be better to stay with your existing investments if the investment thesis hasn't changed and the valuation is still attractive. There's nothing wrong with staying with a company investment for a long period of time, as long as the story is still intact and the valuations are good. Some of my worst decisions were based on my boredom. I was just tired of watching a stock doing nothing. It was like waiting and waiting and waiting for a flower to bloom. So I sold it. And later, boom, those things that I was expecting the company to do actually did it, made some good announcements. Maybe something I was expecting to happen to the industry that would be favorable for my investments happened. But it was too late for me. The stocks popped. I wasn't there. I couldn't reap the added benefits. So sometimes you have to just be patient and just wait for the story to come through in the stock price. Now, let's say you have your financial affairs in order. You know your risk tolerance from a personal perspective and also from a time horizon perspective. Now, along comes someone in your life, perhaps a brother or a friend or your father or a stockbroker, who tells you how to invest according to their risk tolerance and their time horizon. They may have lots of resources and they're giving you their best ideas because they care about you on some level. Maybe they're ultra conservative and they're not. Maybe you're a big risk taker and they're not. Maybe you don't understand the business and he or she can't explain it to you. You see all of your results, all of your returns on your investments, but you don't see their results and their returns on their investments. And their timeline for investing might be significantly different from your timeline. These great ideas could be a small portion of their total investments, and you could be putting all of your money into their one idea. But we always want to be diversified. We never want all of our money in a single investment. That's putting your eggs in one basket. We have some key questions as we're laying the groundwork for that money tree. Are you investing in a style that's right for you? Are you committed to staying the course with your investment strategy? Are you diversified? Will others be there to calm you, to calm your nerves in the middle of the night when something goes wrong with their ideas? You need to stand back, reflect on your own risk tolerance and your own timeline. Then remember what Shakespeare declared, "To thine own self be true." Thanks so much for listening. If you have a question that you'd like answered on the podcast, you can reach out to me at mmontaigne@mosaicconsultingllc.net. Perhaps you want to be anonymous. Perhaps you would like to be on the show with me, live from the potting shed.